too many people get caught up in the guru syndrome and saying, oh, this guy said, this is the best result. You need to have this result for backtesting in order for it to be a good result.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Walter. So this is a common question, but how do you determine what is a good backtest outcome?
Well, it depends on your objectives. So some people, for example, will just backtest with a consistent lot size. So they just take like one lot and they just want to see, does the system, is it profitable? Mm-hmm. So they don't want to have any impact of risk management, like fixed fractional or whatever, right? Fixed ratio, fixed fractional. So they'll just, so it depends on what your goals are. So I would say, if your goal is to determine whether the strategy makes money, then you can just find that by not using any risk management or anything. If your goal is to determine, what are my drawdowns going to look like? Well, that can be tweaked with risk management, right? Like risk management is the way that you can make the equity highs higher and make the valleys lower, right? So that's really important. So it just depends. Like sometimes you might be backtesting to go, okay, I have this strategy, this breakout strategy I really like. I want to add like a trend following strategy. So I'm going to test this. And then what I'll do is I'll map them together. So I'll take all of my backtesting data or my live data from my breakout strategy, and I'll map it onto my trend following so that the trades are in sequence. Like they're, January 8th, they both have a signal, you put them together because you want to see how does that flatten my equity curve? What does that look like? Did the trend following strategy take a bite out of my deep valleys in my breakout strategy drawdown? You know what I mean? That could be another goal. So it really to me, it really depends. So the thing that traders need to remember is the risk management is the way that you can shallow out your drawdowns, and just using one lot is the way that you can determine whether the strategy has an edge. And putting strategies together, the backtesting data together, is a way that you can see how your portfolio is going to operate, and how, that's what people say by diversification, right? People will say you diversify by strategy, by market, but really it turns out that, just diversifying by market doesn't really get you that much. It's more, strategy diversification. And feel free to fact check me on that, because you'll find that it really is the case that you'll hear everyone say, well, just trade it on the Euro Yen and the CAD Swiss. Well, no, that's not. I'm telling you that the markets are so intercorrelated that you'll get some gain there. It will help a little bit, but it's not anything like having a breakout strategy and a trend following strategy trading at the same time. Like that's what you really want is different types of strategies that make money in different types of markets. So yeah,
even within the same strategy, right? You can tweak it a little bit. Like maybe if you trade the Euro Yen without a trailing stop and just 1 hour profit target, and then on the Euro US dollar you have a trailing exit, and then diversify that way.
Yeah, that's a different strategy. I'll have totally different outcomes. In fact, that was something that I did a video for my coaching clients yesterday or the day before, and I was saying that's exactly what you just said is so true. What you will get when you change your exit is a different distribution of winners, right? And that curve will have, for example, if you have a trailing exit, what you typically have is what's called a positive skew. You can look that up, or we can put it in the notes. But a positive skew is just like a bell curve that has a long tail, right? And that long tail are those big winners. Like, for example, one of my coaching traders, he was posting his data, right? And I said, okay, this is what I would do with it to have a look. And he had a trailing exit, and this is no lie. Okay, he's trading the 15-minute big shadow trades, and he had one trailing exit that made $916. This was a $100,000 account, okay? So in his back test. So one had $916 winner. Guess what the largest one was? That was one of the, I don't remember what the smallest one was. That probably wasn't the smallest, but it was one of the smaller winners. It's because he was risking like $2,000, right? So he had two trades. He'd have a target and he'd have a trailing exit, and they're both risking around $2,000, right? And then by the end of it, it was $4,000 because the account had doubled. But so he would basically have about $2,000 would be 1R, right? So he had a $900 winner, and the biggest winner that I saw there was 19,000. So imagine that. Imagine risking $2,000, or maybe the account was bigger and it was $3,000. Okay, so the account was up to 150, and he was risking $3,000, let's say, right? Even then, risking $3,000 to make 19, right? Like that's a huge. Or even if it was at $4,000, even if his account was at $200,000 when that trade came up, still that's like almost 5R, right? Like that's a huge return. But that's what the positive skew looks like when you put all of your trades that have the trailing exit. You should see that positive skew, right? That tells you that it's backing a few really massive winners like that, and that made a big difference, right? If his account made $100,000, that $19,000 winner was 10% of it, right? That was 10% of his winners just on that one on that one trade. And the same thing happens when you do a distribution of your exits, of your target exits. Like we have a hard target, you should see a really tight, high, peaky, normal curve. So it's a totally different look. And that's showing you what's happening when you use it. So what you were just saying is absolutely true. You can change the strategy just by changing the rules of the exit. It's a completely different strategy, completely different curve on your winners and all that. Now, the losers should look the same because you're using a stop loss, right? So that cuts them off right here on the other side of the normal curve. That doesn't happen. Something weird is happening. Like something's wrong, right?
Yeah.
If you don't have that. But so that's true. It's a real, and traders forget that you can change so many things by the exit. They forget that you can actually take a strategy that you're about to throw away and make it really sexy by changing the exit. The exit rules are a huge game changer. So yeah, I'm with you on that one for sure.
Yeah, and I think what it comes down to in backtesting is like, what makes sense to you? What do you want? Like you talked about the big winners, right? Some people enjoy the big winners. Other people enjoy like the consistency, like a small win, but win most of the time. So I think you really have to ask yourself, what is that? It's important to look at the results of the test and see like a yearly and monthly breakdown and see if that's something that you could live with, or that's something that would excite you, and maybe not take anybody else's advice on what is the best backtesting result to have, right? Like I think too many people get caught up in the guru syndrome and saying, oh, this guy said this is the best result, you need to have this result for backtesting in order for it to be a good result. But ultimately it's up to you.
Yeah, and I agree, and that's why. Yeah, that's exactly right. That's why, there's a trader out there who has a statistic that he puts on trading systems, and it's supposed to tell you how good the strategy is. And my argument against that statistic is that it penalizes systems with trailing exits. It will give a higher score to a trading system that has a consistent target, where the amount that the system makes is consistent, right? And it doesn't vary that much. As soon as you introduce variation to your winners, it penalizes that because of the way the calculation is constructed. And I dispute that. I don't agree with that. I think that if you're willing to live with, like exactly what you said, if you're willing to live with the variance in outcomes, a trailing exit is a better approach, provided that it occasionally will capture those really big winners at the tail end of the curve. You heard the term fat tails. Like that's what a good trailing exit will do for you. You can make a trailing exit that actually almost has the same peaky normal curve that a target would, like a 2R target or 1.5R target. You can make a really tight trailing exit and it will approximate that. It won't be exactly, but it will be close. So it's totally up to you and what you want to do. But that's why I don't like the idea of trying to reduce your variance. I understand why people would want that, because like you're saying, some people are going to say, I want a consistent thing. I don't care about the $19,000 winner. I just want to hit these $3,000 winners all month long because I got bills to pay. Okay, fine. That's cool. That's your decision. That approach fits you. That's great. Or you can have both. You can have the target and the trailing exit, and then occasionally get the big fat winner, and occasionally, but a lot of times you're hitting just little singles and doubles, to use a baseball term, right? You don't have to hit the home run every time. So yeah, it just depends on what your goals are and what you're looking for. Yeah.
Yeah, totally. All right. Thanks, Walter.
Thank you.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.